Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Don Calcagni. He's the Chief Investment Officer with Mercer Advisors. Don, it's great to have you back on the show. Welcome to Trade Talks.
Thank you, Jill. It's great to be here.
All right, let's talk about what's been one of the hottest topics this year and most recently of late, inflation. Do you expect inflation to run hot, or do you think we're at an inflection point here?
I expect inflation, Jill, to continue to run hot until these supply chain disruptions ultimately get ironed out. On top of that, we have to keep in mind the consumer is in a really good place financially. They're sitting on some pent-up savings. So until such time that those pent-up savings have been spent down, and until such time that those supply chain constraints ultimately ease up a little bit, I'm expecting inflation to run hot. I think second half of next year is when we're going to cross that inflection point that you referenced. And I do think we might even see some deflationary pressures throughout the economy in the second half of next year.
How will inflation and supply chain constraints impact GDP growth overall?
Well, at the end of the day, once those supply chain constraints ultimately ease up, that's going to allow companies to really rebuild their inventories. So we're expecting that a lot of GDP growth next year is really going to come from inventory rebuilding. And certainly it'll be easier for companies to do that. It'll be easier for companies to engage in more CapEx spending next year. And those are the things that are really going to drive the economy. If we don't get these supply chain constraints ironed out, ultimately GDP growth is going to be constrained going forward.
And stocks have enjoyed a remarkable recovery from the pandemic lows. With valuations at these levels, what are your expectations for 2022?
Well, if indeed the Fed ultimately acts on what they are promising in terms of speeding up their taper, probably raising rates 2 to 3 times next year, I think what we're going to see within the equity market is we're going to see a rotation out of those longer duration assets, those growth stocks, those high valuation stocks, into shorter duration stocks, value stocks, things like that. I think we could see the same thing in the fixed income market. Shorter duration fixed income should outperform longer duration fixed income. I still think there's some opportunity for high yield fixed income to outperform next year. But generally speaking, Jill, what we want to see is we want to see investors pivoting more into value stocks to prepare for what is ultimately going to be a rising rate environment next year.
And finally, Don, so what does this mean for investors at the end of the day?
I think really 3 things, Joe. I think when we think about building a portfolio for 2022, we want to make sure we're focused on assets that have cash flows that are tied to the consumer, cash flows that can grow, not fixed cash flows. We're looking for cash flows that are tied to nominal GDP growth. Things like equities, infrastructure, transportation, floating rate fixed income. Those are the places where investors should be. I would also argue that investors should be mindful to keep a global perspective. There are other parts of the globe that are much, much earlier in their COVID recovery phase, thinking of Europe, thinking of emerging markets. So we do think it's important for investors to have a global perspective heading into next year.
All right, Don, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.